Well, I don't see a bubble per se, but I do see some parallels in terms of risk tolerance amongst investors kind of taking on kind of if you want to think about it, a sense of there's nothing that can go wrong kind of phenomenon. And we see that through our panic euphoria model. We see it in extended valuation. Even things like earnings revision momentum and earnings guidance showing some weakness is not having an impact. So investors really believe this is going to be a blow off here already. And you can see it in the stock prices.
Even if the economy, Tobias, hits the ball out of the park and rebounds very strongly, what level of pullback do you think we could see at any moment in the year ahead?
So, well, if I enjoy the baseball metaphor from the Brit, but look, I think people already understand. I think people already understand the notion of we're going to have a very strong economy. You could have a very good company and not necessarily have a great stock. And similarly, you can have a strong economy and not necessarily have markets anticipated it. Usually stock markets move about 9 months ahead of the earnings. And we would argue if you kind of track what the market's doing, you're almost discounting $190 in earnings for the S&P 500, which would be about 10% ahead of expectations already. So the street is anticipating some powerful economic data spurred on by fiscal stimulus and the benefits of vaccination in terms of economic reopening.
So you don't like all the frothy sentiment, the higher valuations, the idea that it's going to be great and it can only get better. What do you do about that, Tobias, then? How should you position yourself for some caution?
So I think one of the ways you can do it is kind of scale back a bit on the relative performance of small caps over large caps. That's been a great trade for the last 6-9 months. Our lead indicator model is saying that trade is probably spent and you're probably a little bit safer in some of the bigger cap stories. Number two, we look for companies that have pricing power. If there is going to be, and certainly some very respectable people believe there may be some significant inflation developing, that, and again, when I say significant, let me be clear, we're not talking about hyperinflation, but if we get the prints of 3-4%, does the market kind of get a little bit squeamish? And in that case, find the companies that have pricing power that can kind of deal with it. Because if you get, for example, commodity price increases you can pass through to the customer base right away, and you'll get it a quarter or two later, that still could create some earnings hiccups. And there's not a whole lot of room for disappointment.
So, Tobias, what about sector basis? I mean, I guess you've touched on it in one sense with small caps and cyclicals versus growth, but what about specifically by sector?
So, look, we still think the capital goods group is an area that's going to benefit meaningfully from an improvement in capital spending. We track over 700 companies' capital spending numbers, and they are improving versus what we even saw 3 months ago. Number two, anything tied to kind of the leisure, hospitality, travel component, and I shouldn't say anything. There's certainly some stocks that are probably already anticipating this, but there's just enormous pent-up demand. The thing we've all been deprived of the most has been going out and doing things. We've been able to buy a car, and people were last year because they were afraid of, let's say, taking public transportation for fear of infection. They were buying, laptops and tablets for their kids, remote school. So you had all that already activity in terms of goods, but services is the place where I think you're just going to be blow off demand, and it'll carry into 2022 because we're probably not going to be able to do everything we want to do, especially when you think about $2 trillion or so of incremental savings over the past year plus.
Wanted to get your call on small caps on the record. They had a tough day today, even though the S&P went to a record high, down about 1.6%. They're 6% off the highs? Is it a positioning thing? Did that get too crowded, or is that value trade no longer the hot thing?
It could be a number of things. I don't think the value trade is the right way to think about it because, for example, a third of the companies in the Russell 2000 are unprofitable. You got a bunch of biotech companies that got to prove themselves, for example, a bunch of energy companies that suffered in the downturn. So it's more the constitution of the index that has that impact. But I think if you're looking at value, it still makes sense that bond yields are moving higher from our perspective as well. But again, I want to be a little bit careful, just not chasing everything that is tied to either value or tied to economic sensitivity. For instance, we're not that bullish on materials because in the U.S., 80% of the material sector is chemicals. It's not metals and mining. If you're going to Latin America, Asia, Europe, you'd see the reverse. 80% is metals and mining. So it's kind of a different composition that we have to be aware of.
Tobias, thanks so much for joining us. Much appreciated as always.
Shepard Smith here. Thanks for watching CNBC on YouTube.